What if one number could cut through the noise and reveal a stock's true price? The pros use this for a quick gut check before they even think about buying. It isn't a secret formula, but a simple tweak to a ratio you probably already know, a tweak that changes everything. Stick around, because this could reshape how you see stock prices forever. Section 1. The problem with stock analysis. Valuing a stock feels like drowning in data. You're hit with a tidal wave of ratios, PE, PS, ROE, and countless others. The real danger is that without a simple way to gauge value, you're flying blind. You risk overpaying for hype, buying a company that's a sinking ship, or missing out on incredible growth opportunities. Section 2. The flaw in the PE ratio. Most people start with the price to earnings or PE ratio. It's simple: stock price divided by earnings per share. A low PE seems cheap and a high PE seems expensive. But the PE ratio is deeply flawed because it says nothing about future growth. A company with a low PE of 10 but zero growth is a value trap. A company with a high PE of 30 but 40% annual growth might be a bargain. PE alone can't tell you the difference. Section 3. The solution. The PEG ratio. This is where the price earnings to growth or PEG ratio comes in. It's a simple upgrade that adds the missing ingredient, growth. The formula is PEG ratio equals PE ratio annual EPS growth rate. By dividing PE by the growth rate, PEG tells you if a stock's price is justified by its future profits. The classic rule of thumb, made famous by investor Peter Lynch, is a PEG below 1.0 suggests a stock may be undervalued. A PEG above 1.0 suggests it may be overvalued. Suddenly, the expensive stock with a high PE of 30 and 40% growth has a PEG of 0.75, a potential bargain. The cheap stock with a PE of 10 but 5% growth has a PEG of 2.0, likely overpriced. Section 4. How to calculate it. You can find these numbers on any free finance website. 1. Find the PE ratio. It's on the main summary page for any stock. 2. Find the growth rate. Click the Analysis tab and look for the next 5 years per annum growth estimate. This is your G. Do the math. Divide the PE by the growth rate. Use the growth rate as a whole number, so 30% growth is 30. Section 5. A word of warning. The PEG ratio is an amazing screening tool, but it's not a magic bullet. The G for growth is just an estimate. Analysts can be wrong. It also tells you nothing about a company's debt or leadership. Think of the PEG ratio as your first, most powerful filter. A low PEG is not a buy signal. It's a signal to get excited and start doing your homework. While most people get stuck on the flawed PE ratio, you now have a tool that gives you an edge. By dividing PE by expected growth, the PG ratio gives you a forward-looking perspective on value.